Welcome back from Palantir to Bitcoin to the mega caps. Several high-flying parts of this market have lagged lately, leading some to wonder whether a broadening is in fact in the early stages. Let's bring in Bill Miller IV. He's chairman and CIO of Miller Value Partners. Welcome back. It's good to see you.
Great to see you, Scott. Thanks for having me.
You're a believer in that premise, aren't you?
In the broadening of the market, absolutely. I think what's really interesting is if you look at last week in the Russell 2000 index on Tuesday, 90% of the names in the index were up. And then on Wednesday, so that was the first time you'd seen that level of breadth in over 3 years. The following day, Wednesday, you saw over 80% of the names that were up. That's a breadth thrust, and that often happens at major inflection points in the market. We think there's a reasonable probability that over the next few years, we see a similar environment to what we saw between 1999 and 2006. At that point, large cap growth stocks, over that period, large cap growth stocks lost 30% of their worth, while the small cap value index nearly tripled and effectively outperforming the market by 20% per year, or the large cap growth segment by 20% per year for 7 years. And again, we see a similar macro setup, and we've got low but a little bit rising unemployment. We have inflation that's largely been brought under control, with monetary policymakers being encouraged to ease. If you look at what's going on right now with the change in leadership at the Fed, along with potentially increasing access to capital for housing, you could see a very similar environment to 2000 to 2006.
But
so from our perspective, you want to actually own small caps, cyclicals, and you want to be very aggressive here.
Can't you make, I'll come back to you on the very aggressive notion in a minute, but can't you make the argument that the price action that you referenced from earlier last week in small caps specifically was the market over its skis on the idea of rate cuts, and then we got some inflation data later in the week, PPI and otherwise, which suggested that, okay, maybe the Fed's not going to do what we thought, and then that's why you saw the small caps unravel the way they did towards the later stages of the week.
Well, that's possible. But at the end of the day, the policymakers want the economy to grow. They want inflation to be stable. The bond market currently expects 2.6% annualized inflation over the next 2 years. Very manageable. And one thing that I think is often not talked about when you think about the relative discrepancies between large growth and small value is the valuations. And so what you're seeing, at least with Mag 7, is very high valuations relative to the rest of the market and everything else at a time when their capital intensity is going through the roof. So I just looked at this before the show. 5 years ago in 2020, Mag 7 had about $100 billion in CapEx and $320 billion in operating cash flow. And then last year, $550 billion operating cash flow. It looks like they're going to spend about $350 billion in CapEx. So you've gone from under a third of operating cash flow in CapEx to now a much higher number, over 60%. And so will all this pay off? Everyone thinks it is. Everyone's optimistic about it. But those are some big spending numbers, and we have yet to see whether they'll be justified over the long run.
I mean, you talk about capital intensity, your words, as a negative, rather than the positive that others see, that if you're going to build all these digital roads and these pathways into the future, it costs a lot of money to do it, and it's obviously going to pay off. It just may not pay off on the time frame that some want.
Well, maybe, or it could be the case that everyone's spending the same money on the exact same or similar models that at the end of the day may not end up being that different. And so then they're going to have a price war at the end of the day. Who knows how it actually plays out? But, from our perspective, there are some compelling values in the space. I think Alphabet is the value investor's way to invest in AI. When you look at the assets they have, not only are they creating the models, they've also got the distribution between YouTube, search, Waymo. So you got a lot of shots on goal at Google. It trades at a discount to the market despite having much better growth, much better moat and everything else. So we like Alphabet a lot.
Well, since you went there and you mentioned a moat, I mean, the reason why you can make an argument that it trades at such a discount to the others is because some question whether the moat's been breached. And what looked like a moat maybe isn't, because of some advancements in AI that are going to cut down on what was an overwhelming amount of market share.
Yeah, that's a fair point. But at the end of the day, they are in 7 out of 10 people's hands all day, every day in the Android operating system. And that's a moat. So that's not going away anytime soon, and they'll figure out a way to make money on it.